Hello, good morning, everybody. Today I'm to start with the topic Partnership Fundamentals of Class 12th. It's the first chapter which gives you a notation that what is partnership firm. First of all, we need to understand that what is partnership firm. Partnership firm means that there should be minimum two people who are going to work for the firm, right? So it is the minimum number should be 2 and the maximum number it's actually notified as it can be 10 in case of banking companies or insurance companies and 50 in case of manufacturing concerns. Right now we are going to study that if there are so many people and they are going to work in one firm, how will they do all the provisions? Like in sole proprietorship, we have done in class 11th that one person is doing the whole business. When he is performing all the things, all the profits are going to only one person, right? But now if there are two or more people, now what will be happening? So what they do is all these people, they decide and make a partnership deed. What they want is a partnership deed. Now what is a deed? It's a written document. Deed itself says that there is something which is being decided, right? So it's a written document in which all the provisions are seen. What will be the profit sharing ratio of the people, right? If there are, suppose we say that there are three partners, what will be the PSR? PSR stands for profit sharing ratio. Now profit sharing ratio can depend that if a person has contributed more capital and other partners have contributed less capital. So PSR can be in the capital ratio or even anything else. And if there is nothing which is mentioned in the deed, then it becomes is equal, right? So this is the provision if there is no partnership deed. But otherwise, if the decided PSR is there, so the decided one will be used. Next thing which is important in this chapter is IOC. It stands for interest on capital. Now interest on capital means that the capital which the partner has contributed in the firm, he needs to get some interest on that. If there is a deed, again the same thing. If there is a deed and there is a percentage, we will use 6%. And if there is no deed, then what will happen is that there shall be no interest on capital. So in the PSR, again, if there is a deed, then the decided will be used. D stands for decided. And if there is no partnership deed, then that shall be equal. Okay. Next important thing in this chapter is interest on drawings. Again, if there is a deed, then suppose there is a rate which is fixed is 8%. But if there is no deed, then there will be no interest on drawings. Next thing is interest on loan. This is an interesting fact that there is no interest on capital, there is no interest on drawings, but there is interest on loan even if there is no deed. So if there is a deed, then the decided ratio is again going to be used. But if there is no deed, then the rate of 6% per annum shall be used. That means if a partner has given some loan to the firm, he will be getting interest at the rate of 6% on that specific loan. And last thing, it is either you can say salary or you can even say remuneration. Yes, the salary and the remuneration, again, if there is a partnership deed, then the decided salary will be given to the partners. But if there is no deed, so then there will be no salary or no remuneration to the person. So these are the main 5 provisions according to which you will understand that how the partnership books are being maintained. Now, what are the certain books which are going to be maintained in a partnership? When the books are being made, the first account which is made is profit and loss appropriation account. The name is profit and loss appropriation account. Now what is this account? Profit and loss appropriation is what? When the profit and loss account, which you have already studied in class 11th, it ends up from there. What begins is profit and loss appropriation. So this was a P&L account which was already studied in class 11th, right? But where it ends up, the last item which you can recognize is to net profit. I hope everybody knows that when you are calculating the net profit of the firm, then profit and loss account will give you a profit named net profit, which is now going down to the P&L appropriation as an opening balance, right? So this was the closing balance of P&L account, and now the balance from the profit and loss becomes the opening balance of profit and loss appropriation. So it will be written as by net profit brought down. You remember we wrote net profit carried down in case of P&L account, and now according to the crisscross method you can see that this net profit is coming down, and which is being displayed now here as net profit brought down, right? This is the first item which will be mentioned in the profit and loss appropriation, and then you will see that there are certain adjustments. Now those adjustments, or if you just understand that what is the basic concept, actually this P&L appropriation is of the firm, it's not of the partners, it's of the partnership firm. So if you think interest on capital, I'll talk about all the expenses individually. If you see first thing, that is interest on capital. What is actually interest on capital? Interest on capital is when there is a partner. Suppose this is a partner and this is the firm, right? Now the partner has contributed the capital into the firm, right? Now when he introduces the capital in the firm, he expects to receive interest on capital. So here you can see the firm is paying IOC. So the firm is paying, therefore it can be called as an expense of the firm, and expenses are debited. So it will go to the debit side of P&L appropriation. Why? Because it's an expense of the firm. So we will be writing to interest on capital. So I'm not going into the calculation part. Firstly, I'm just coming to that what things will be coming on the debit side and what things will be coming on the credit side. So if there are two partners, say suppose A and B, so the interest on capital, the amounts will be calculated and they will be written on the debit side of the P&L appropriation account. Now coming to the next related item, which is just opposite to this, it is interest on drawings. Now coming to the interest on drawings part, what is it now? According to that, this is the partner, this is the firm. This time drawings means the partner is withdrawing money from the firm, right? So this is called drawings. Now, the partner says, when I contributed the capital, the firm said that interest on capital needs to be paid. Now, if I am withdrawing, that means I need to reverse and pay what? Interest on drawings. Now, you can see the money is coming into the firm. That means it's not an expense, it is an income. And incomes are credited according to the rule. Right? So according to the nominal rule, income should be credited. That means this is the credit side and we will be writing by interest on drawings. Again, A partner, B partner, there are certain amounts and they will be coming out. Right? Now coming to the thing that was IOC is done, IOD is done, we say IOL. Now interest on loan is the thing which again is to be seen according to the percentage. We saw that if there is no deed, then the decided percentage will be used. But if there is a deed, then the decided percentage will be used. And if there is no deed, then 6% will be used. Right? So interest on loan is now what? It's an expense. So to interest on loan. Say only if A has given the loan, then only A will be getting the interest on loan from the firm. Right? If there is any salary or remuneration, again the same contribution. We suppose that now this time only B is getting the salary, so the decided person is getting it. Now calculating the result, that is the answer. Now how you have to calculate that, what is the profit or what is the loss, right? Now here you can see that the total will be coming out from the credit side, and this total will reduce all these items. Whatever is the balancing figure, it will come here, and the name shall be to profit on appropriation account, right? So this is to net profit transferred to partners capital. So if there are two partners, A and B will be receiving the interest, and again the balancing and the closing will be done as you already have done in profit and loss account. Now the next thing which we can understand is that how we calculate the interest on capital and how we calculate the interest on drawings. Now for this, I will be showing you a concept which is something like this, that interest on capital calculation, how this calculation is to be done. Now calculation says that you have to calculate the months actually here, right? As you have already seen that the loan and this thing, they all include the months part. So the percentages are to be applied not as just the year. That means it's not to be done yearly, it is to be done monthly. Now suppose there is a partner A. He has contributed 1 lakh on 1st April 2016. Right? Now, on 31st March 2017, we want that what shall be the interest on capital of this specific partner A. Now, when I want to calculate this, what I have to do is I also have to see that the interest on capital which I am calculating, it should include all the adjustments. Suppose I am drawing a line over here just to show that there is actually some addition in between, say on 30th September 2016. Now if you see that the person has contributed on 1st April, he has contributed 1 lakh rupees, right? But he is not just using this 1 lakh as his capital, he has introduced 50,000 more, but on some separate date, right? And I will tell you a shortcut where you can just apply it so that you get the correct amount. There are 2-3 methods which may obviously confuse you. So you have to be very sure that you just use that method which is applicable everywhere. Now what you have to do is you just have to calculate IOC. Say the percent is 6% given in the question. So what you will do is you will write that IOC to be calculated, right? First is 1 lakh rupees for 6%, and for the full year or for some months. Now please check from 1st April to 31st March. It's 12 months, right? So writing 12 upon 12 is nothing. You can just write that for 1 year he has contributed this money, right? And the other thing which he has done is plus 50,000 also at the rate of 6%, but 30th September he has introduced it. That is, we will be counting from the next date, that is October. So October, November, December, January, February, March. It comes out to 6 by 12. So you will be calculating both the amounts and then you will be totaling them out. This is the interest on calculation part. Now I can also take a person who has contributed 2 times in 1 year. Say he has 1 lakh again on the rate of 6% on 1st April. So 1 by 1 means for the full year, right? Or you can also write 12 by 12, then also the same thing will come out. But if he introduces 30,000 on, say, 1st June, this was from 1st April, right? Second is from 1st June, and third you can take is from 1st December. It's anything, right? The question can include anything, right? So what you have to do is you just have to apply the months from the specific date towards 31st March. That means the calculation date will always end up to 31st March. Now please calculate from 1st June. So June, July, August, September, October, November, December, January, February, March. So therefore 10 upon 12, right? And from 1st December, say he has introduced only 20,000 at the rate of again 6%. And now from 1st December, if you see, so December, January, February, March, only 4 months. So 4 upon 12. Whatever amount shall be coming here, here and here, the total will be done, and you will be using the total amount for writing interest on capital in the part of B partner. I hope all this concept is clear. Now I will be making another video for showing the calculation of interest on drawings. Thank you so much for watching this video. Please like, share and subscribe. Thank you. Mama.